What if I told you that presidents don't fully control their country's economies? That elections don't really decide monetary destiny? That behind every war, every recession, every stimulus package, there exists a quieter authority, one that doesn't campaign, doesn't debate, and doesn't face voters. We're told governments run nations, but governments borrow. And the power to create money, the lifeblood of every economy, belongs somewhere else. Tonight, we follow the moment history quietly shifted. When central banks took control of global power, setting the stage before the shift to understand how this happened, we have to go back to a time when money meant something physical. For centuries, gold and silver were money, not symbols of value, actual value. If a government wanted to spend more, it needed more metal. If it went to war, it needed gold reserves. Expansion was limited by reality. Then came modern banking. In 1694, the Bank of England was created to fund war debts. It introduced a powerful idea. Governments didn't need to have money before spending, they could borrow it. That small innovation changed everything. Soon banks realized something else. They didn't need to hold all the gold deposited with them. They could lend most of it, keeping only a fraction in reserve. Money reserve banking was born. Money was no longer just metal. It became a ledger entry. Fast forward to the early 20th century, financial panics were common. Bank runs destroyed savings. Markets collapsed unpredictably. The solution? A lender of last resort? In 1913, the Federal Reserve was created in the United States. It was presented as a stabilizer, a shock absorber, a protector. But it also gained something unprecedented: the authority to create money. Quietly, power began shifting not from one political party to another, but from governments to central banking systems. And most people didn't notice. Origins, the mechanism of control. Here's where it gets interesting. Governments spend money on infrastructure, welfare, military, public services. When tax revenue isn't enough, they borrow. From whom? From bond markets. And who influences bond markets? Central banks. Central banks buy government debt. They create money digitally to purchase bonds. This lowers interest rates and encourages borrowing. At first, this seems harmless. But think about the cause and effect. Government wants to spend more. It issues bonds. Central bank buys bonds using newly created money. Money supply increases. Inflation rises. Purchasing power falls. Now the government depends on central banks to keep rates low. And central banks depend on governments to maintain the system. It becomes a feedback loop. Debt stops being temporary, becomes permanent. The rise when money became policy, the true shift happened in 1971. President Nixon ended the gold standard. The US dollar was no longer backed by gold. It became fiat money by decree. This wasn't just a technical change. It meant money creation was no longer tied to physical limits. From that moment on, central banks could expand balance sheets infinitely. Governments could run deficits indefinitely. Debt no longer needed repayment in gold-only refinancing. Global power began consolidating. Because the country that controls the world's reserve currency influences global trade. The US dollar became dominant. Oil was priced in dollars. International debt was denominated in dollars. Central banking decisions in Washington affected economies in Asia, Africa, Europe, and Latin America. Interest rate hikes in one country triggered recessions in another. This wasn't conspiracy, it was structural power. The ability to influence global liquidity became more powerful than military dominance. Money flows became geopolitical weapons. The breaking point: crisis after crisis, then came the crises. Banks collapsed, housing markets imploded, trillions vanished. What did central banks do? They printed. Quantitative easing injected trillions into financial markets. Interest rates were cut to near zero. Asset prices soared. But something else happened. Wealth inequality widened dramatically. Why? Because when money is created, it enters through financial systems first. It inflates stocks, bonds, real estate. Those who own assets benefit. Those who live on wages feel inflation later. The pattern repeated in 2020. Pandemic. Shutdown. More printing. More stimulus. Global debt crossed $300 trillion. Governments became more dependent than ever. Central banks became more powerful than ever. But here's the twist. The system now requires continuous expansion. If rates rise too much, debt becomes unpayable. If rates stay too low, inflation explodes. The system is trapped, not fallout. The quiet consequence is what happens when debt grows faster than economies. You don't see immediate collapse. You see slow erosion, currency debasement, rising living costs, housing affordability crises, savings losing purchasing power. People work harder but feel poorer. Meanwhile, central banks expand mandates, climate policy influence, digital currency experiments. It's financial surveillance tools. Central bank digital currencies, CBDCs, could allow programmable money that expires or restricts spending categories. That's not speculation. It's policy discussion in multiple countries. Power isn't just about printing anymore. It's about controlling how money flows. And whoever controls money flows influences behavior. Failed fixes why the cycle continues every few decades. Reform is promised. Tighter regulations, balanced budgets, debt ceilings. Yet total global debt keeps climbing. Why? Because the modern economy is structured around leverage. Growth depends on borrowing. Consumption depends on credit. Asset prices depend on liquidity. If central banks suddenly stopped expanding money supply, markets would collapse. Governments would default. Pensions would evaporate. The system survives by postponing reckoning. Debt is refinanced, not repaid. Crisis is managed, not solved. And power continues consolidating quietly. Modern parallels the pattern repeats. Look at the pattern. Crisis intervention expansion, asset inflation, dependency bigger, crisis repeat. Interest rate cycles now determine elections. Bond yields move currencies. Currency swaps influence diplomacy. Financial sanctions replace military invasion. The battlefield has shifted. The control mechanism isn't tanks, it's liquidity. And the central institutions managing liquidity hold enormous structural influence, not through secret meetings, but through policy levers. Most people don't understand. The average person debates politics. The real shift happens in monetary policy. They reveal what this really means. So, when did central banks take control of global power? Not in one dramatic coup. It's not through secrecy alone, but through necessity. Every crisis increased their authority. Every intervention expanded their reach. Every bailout deepened dependency. Power didn't shift overnight. It accumulated. Quietly, incrementally, systematically. And now, reversing it would require dismantling the debt-based structure modern economies rely on, which no government wants to do. 3 clear takeaways. 1. Control over money is control over outcomes. Whoever controls the supply and cost of money influences everything: housing, jobs, wars, elections, and global trade. 2. Debt is not temporary in modern systems. It's structural. The system requires expansion to survive. Paying everything off would collapse the framework. 3. Crises expand authority. Every emergency increases central banking power. Each solution creates deeper dependence.